I think a buyer and a seller go into a transaction with an understanding at the outset of what the value of the transaction is, but through diligence, things may, rear their ugly head. The buyer may discover things about the business that make it less desirable, and as a result, tend to try to retrade on price to reduce the price to address those issues.
Welcome to the Middle Market Moment, where we speak to other professionals who help business owners build value, de-risk their companies, and prepare both personally and professionally to do the deal of a lifetime through M&A. Today, I want to welcome Evan. Evan is an attorney and partner at Eisenhower Carlson. Evan counsels business owners in a variety of transactional matters, including corporate formation and governance, business acquisition and sales, buy-sell agreements, secured transactions, real estate transactions, and commercial lending. Hi, Evan. Welcome.
Hey, Craig. How are you?
I am awesome. I am a few days away from a Mexican vacation, so the countdown is on.
Excellent. I'm jealous. It's dreary here in Tacoma, and I'm jealous that I wish I was going to Mexico as well.
Yeah, indeed. Well, I've been looking forward to this conversation. I know you and I have done some business together on the M&A front before, as our firms have collectively several times over the years. And having let the audience know that there's a comfort level with getting deals done, and it's not always easy, but we find a way, don't we?
Indeed, for sure.
Well, we also spend a good deal of time, thinking about and talking about growing business value, and part of that value creation strategy and assessing whether you're going to be a good candidate for M&A. Would be looking at the risk factors and the preparedness from a legal standpoint. So maybe you can maybe kick off the conversation. And as people are thinking about, hey, is this my year? Should I pursue liquidity? Should I get into a partnership or do some things through M&A? What do I need to be thinking about from a legal perspective? And moreover, kind of getting prepared for that process.
Yeah, for sure. Well, thank you, Craig, for giving me the prompt on that discussion point. My thought process always going into M&A is, and advising clients on value thinking and strategy around assessing whether now is the right time for a liquidity event. Is starting point is surrounding yourself with a good group of advisors. So hiring a good accountant, a good investment banker, a good commercial banker, an insurance broker, and a lawyer to be a financial advisor, to be at a table with you, to strategize about the client's objectives holistically around their business goals, short-term, long-term, mid-term, thinking about their objectives for their business, and then assessing from there different potential strategies for helping them achieve those goals in the order in which they prioritize them. So I always look to start with new client relationships in bringing together all of their trusted advisors and key service providers to make sure that collectively we're on the same page about assessing, advising, and helping a client achieve their goals. From there, from a legal perspective, when I'm digging into a new client's business and helping them assess risk around an M&A transaction, I look to a handful of things. One, their corporate governance documents, making sure that, from a back of the house standpoint, their legal documents are in good order, that they have been compliant with their legal documents, that they follow standard corporate formalities. And then from there, thinking about items that have come up in M&A transactions that have either killed a transaction or impacted value along the way. I think a buyer and a seller go into a transaction with an understanding at the outset of what the value of the transaction is, but through diligence, things may, rear their ugly head. The buyer may discover things about the business that make it less desirable, and as a result, tend to try to retrade on price to reduce the price to address those issues. So my job, if we're a year or two or three out from a liquidity event, helping a client clean up some of those things, you know, making sure that their contracts with key customers and suppliers are rock solid, that the risks involved in those transactional or commercial transactions make it easy to complete an M&A transaction, whether it's structured as an asset or a stock deal, and eliminate some of those risk items that a potential buyer may use to trade on price.
Yeah, that's insightful, and I want to go back to one of the first, comments that I think is critical that you made in terms of putting that deal team together. I think our typical client is 20 million to 100 million in revenues or approximate similar enterprise value typically, and I think in many ways they underestimate. M&A is a full contact sport. Just because you have a business lawyer or somebody who litigated a deal for you over your fence, with your neighbor 10 years ago, that does not make a good partner or a good deal team member when it comes to M&A. Same thing with your accountant, somebody who you talk to do your taxes. You may need to upgrade your deal team. Maybe share with us how you have seen kind of professional advice in those areas really influence an outcome. Obviously, on the legal side of it, representations, warranties, what's market, all of that is very different from many, attorneys' law practices, right? You've got to be in it to know it.
Yeah, yeah, no, Craig, that's a great point. I think from my perspective, knowledgeable deal counsel from a lawyer perspective tends to make the deal easier. Interestingly, oftentimes, we'll get in on one side where we're deal counsel representing one side of a transaction, and they have, I wouldn't say inexperience, but they have an attorney that doesn't do M&A work on a regular basis, isn't familiar with what I would consider market in a transaction. And surprisingly, we'll put together a market deal, but the other side just doesn't understand the market aspects of those terms. What is appropriate for reps and warranties? What is appropriate for indemnity, risk protection? And so, what we find is that those deals are much harder to complete. The lawyers on the other side, we spend more time, either just doing initial review. I mean, they, instead of a typical 1 week turn time, which is what my office strives for on our M&A transactions, we'll see lawyers on the other side take 2-3 months, a month to turn an initial draft of a purchase agreement. And that just slows the whole, that sets the tone for the process, and it just slows everything down. And I think, what I tend to find is that deal fatigue is real, that clients tend to hit a fatigue point. And if I try to push things along earlier and get things closed out earlier, that fatigue is less painful for a client as we go. So, my advice always is make sure, a buyer or a seller hires an attorney that does M&A transactions on a regular basis, that's a big part of their transaction. I liken myself to like a surgeon. I'm not a general practitioner as a doctor. I'm not, doing your regular health checkup. I'm brought in to do a very specific role, and that is to help you complete your transaction and, achieve your liquidity objectives. That's my job. And also to make sure it's done right. Right. So my goal is, one, to meet my ethical obligations to you as a client, to make sure that I'm giving you good advice, but also if your goal is to get the deal done, we're going to get the deal done. That's my job.
Yeah, it's interesting. We've coined the axioms, right? The M&A axioms, and the oldest and most often cited by our clients is they know that axiom that time kills all deals.
Yep.
But to your point, right? If you have inexperienced counsel, or if you have inexperienced counsel on the other side, that takes a month to turn a document, right? Buyers get skittish. They change their mind. They chase other things, right? So yeah, that's really insightful.
Horror story. I've seen it. Like, we had a client just recently that had was targeting a year-end transaction, and it spilled into the new year, and their financial reporting in the last quarter showed a pretty significant drop in revenue. no real reason for it. It just they hit kind of a low spot in their business, and not that they predicted it would continue at that level. They just had a bad quarter, and the buyer said, "Hey, we our financial model says we can't pay the price we agreed to initially." And so the fact that the deal spilled into the new year meant that the price got reduced, and the seller ended up walking from the transaction. So yeah, I mean that's a great example.
Yeah, time kills all deals is one part of it, or it greatly wounds them, right?
Yeah.
Sometimes you can't recover. Well, for most of our audience who are entrepreneurs, founders, folks running lower middle market businesses, the business and the personal is often inextricably linked. And as we're on this preparation and getting your house in order topic, I know your firm does some work on the personal side as well as the business side in terms of getting people prepared from an estate and tax and others. And I know, that's not your specialty, but maybe you can kind of draw the thread. You need specialized counsel for the M&A transaction, but also in tying in your personal objectives as to what you want out of the transaction, which is not always just a top line number. There are other
Yep.
considerations there. Maybe share a little bit about how your firm works with people to get them prepared.
Yeah, that's great question. From my perspective, we as a firm take a holistic approach to representing clients through their transaction. I'm fortunate to have what I consider the best estate planning group in the state working down the hall from me. We have three excellent attorneys that do high level, complex estate planning and trust and estates work. And so it's an easy introduction if a client doesn't have a solid estate plan or estate planning team that they're working with. That's usually in connection with their financial advisor or private banker, um, making sure that in addition to just the liquidity event and the tax consequences of the liquidity event, there's a plan for that money to hopefully create generational wealth. And so we work collaboratively with our team to make sure that the timing is right for the client, the structure of the deal is right for the client, the way that they're getting paid, how they're getting paid, when they're getting paid makes sense from a tax standpoint, or an estate planning standpoint. That if they have charitable objectives, that we're building those into their plan, and that they have a plan for those monies after the sale. So um, oftentimes the clients look at the number on the transaction, but don't really know what that means for their lifestyle. And so making sure that they understand the consequences of their deal is really critical. And that's an initial question. I don't tend to push too hard on it, but it's something I ask at the outset is, do you have a plan? Is your plan, do you feel comfortable with your plan? Have you talked with professional advisors about your plan? And if they say yes, then we'll leave it at that. We'll trust that they have that in order. And I'll invite those folks to be at the table when we do roundtable up at the outset to make sure that everybody knows their roles and responsibilities in the transaction. If they don't, that's a great opportunity for me to introduce them to our team or help them find the right person on the outside to help them strategize their long-term objectives.
Yeah, I think you point out, and it's a great observation. I mean, this ultimately is a team sport,
Yep.
and a lot of times people will treat this somewhat siloed, but you really have to link the personal, the planning, what your future aspirations are. And we have seen it, and I know you have as well, that a lot of folks go into a transaction focused on this big headline number. But at the end of the day, it's how much you keep and is it enough and will it meet your goals, right? So it all goes back to the client goals. And
Yep.
that's why we work well together because we're typically aligned around that. That is the key because at the end of the day, you don't want to do a transaction and realize it's not enough or it's not the right time. You have to be thoughtful about that.
Yeah, and I'll just add that we've seen oftentimes, when you talk about the team aspect of this, that if we don't huddle everybody up at the outset and set roles and responsibilities clearly, who's going to be handling what, things get missed, or we get to the end and they hadn't done their tax analysis on the transaction the way we would have expected them to, or they don't have a plan for the money and where it's going to go when it arrives. Like those sorts of things are so critical. So I can I can tell horror stories for days where we thought one person was doing something and they weren't, and we scramble at the end to get it done. Fortunately, we haven't had a problem getting those transactions closed, but it is a bit of a scramble right at the last minute when we realize, man, something was missed, or this wasn't done, or we thought this person was handling it and it wasn't being handled. And now we're trying, our job is to help get the clients, get our transaction complete. So we're picking up the slack and trying to get all that stuff done along with getting the transaction completed. And, it can be a bit of a struggle, but, so that's why I think at the outset, I'd advise any client, get all of your providers together, all of your advisors in one room, sit down, talk about what your objectives are, the timing, all of those things, and who's going to, and then amongst them, you probably aren't going to know, but certainly someone will take a quarterbacking role, typically the investment banker, and will say, hey, here's what everybody's role is. We're going to collaborate on these aspects of it, but for the most part, this is your role. And if everybody does their job, it will go significantly smoother.
Yeah, absolutely. Absolutely. Well, we have several clients that are in deal right now, and we've had over the last 10 years, dozens and dozens of them. And maybe to serve kind of our audience, maybe I can borrow your legal mind for some
Sure.
things that people don't necessarily always understand. And as investment bankers, I'll admit, a lot of times we throw around jargon and we assume that people know these things. But from a legal perspective, your representations and warranties and your indemnity provisions in a deal, right? You're getting this pile of cash theoretically, right? But you also have some responsibilities. There is what I call a cost to liquidity, right?
Yep.
People don't just hand you money and hope it all works out, right? So maybe and even, imagine if I'm a first time seller, how should I be thinking about reps and warranties and the indemnity provisions in a contract? And in my mind, that's just as important as, the terms and structure are just as important as the
Yep.
top line number or the bottom line number. So maybe put
Yep.
that in context for kind of first time sellers in particular.
For sure. Yeah, happy to. Um, so my role when I'm representing a business in an M&A transaction is kind of twofold. One, it's to take the term sheet that they've signed and that identifies all the business deal points of the transaction and making sure that those are in the agreement. That's what I consider the easy part of the transaction, is just aligning the term sheet with the purchase. You'd be surprised how many times the first draft doesn't reflect what was agreed to on the business terms. And I always query the attorney in my mind on the other side, like, this is what we were asked to do, is make sure that at least the business terms are in the agreement. But then the second side of it is allocating the risk fairly between the buyer and the seller. And as you noted, there is no risk-free liquidity. The seller is responsible for some of the risk of the transaction, but also the buyer is responsible for some of the risk. And we see, certainly from a buyer, when I'm representing sellers, the buyers often present an agreement that doesn't require or doesn't allocate much, if any, of the risk to the buyer. So my job is to make sure that the buyer is bearing what is market level risk. And unless they're paying a massive, and I've obviously never seen this, a massive outside of market price for a business to get a no risk deal, the pricing that they've set requires the buyer to take on some risk. So there are two parts of the agreement that really touch on the risk. The first is the representations and warranties, and the second is what is the remedy for a breach of those representations and warranties. That's the indemnity section. So the representations are a bunch of statements that the seller is making about their business. And it's disclosing information, it's telling the buyer things that, if aren't true, would expose the buyer to risk in the transaction. And so when I look at the reps and warranties, when I talk to a seller, I tell the seller initially, focus on that. You let me deal with the business terms. You focus on the reps and warranties and make sure, go line by line, word by word through those, and make sure that they are completely true. And if you're unsure if they're true, share it with me and let me discern whether that's something we would need to disclose to the other side or not. Let me be the arbiter of that disclosure. You just give me everything. throw it all against the wall and let me decide. And so that's our job, is to make sure that those representations are true. Many of them we can handle pretty easily. Some of them are a bit more complicated. But that is how a buyer and a seller allocate risk, is by confirming the truth or falsity of certain aspects of the business. And then the indemnity section is the remedy. And in addition to allocating risk in what is true or false about the business in the reps and warranties, the representations and warranties, we also provide caps and baskets in the indemnity section that quantify the amount of risk that the buyer and the seller are going to be responsible for. The basket being, for the most part, like a deductible on an insurance policy. The buyer has to meet that deductible and losses before they can come back to the seller for out-of-pocket indemnification or payment. And then the cap being an outside limit on the total exposure that the seller is responsible for. It's usually some percentage of the price, and depending upon the size or the risk of the business involved in the industry that they're in, it may go all the way up to the entire amount of the purchase price. But it's usually some percentage, oftentimes less than half of the purchase price, that the seller understands is their risk profile in the transaction.
Mm-hmm. Yeah, that's excellent. You've summarized that really well. The other thing that sellers should think about, and this should be pretty intuitive, but there are certain fundamental reps that are treated a little bit differently. Maybe speak about that relative to
Yeah, the existence of the selling entity as a corporate or limited liability existence, the payment of their taxes, the ones that are, like you said, fundamental, but that present unique risk to a buyer, that really should fully be the seller's responsibility, because they're not really unknown issues. What I consider fundamental are the things that the seller really was in control of, and there aren't scenarios where the seller wouldn't know whether it's true or false. Their tax reporting and payment of taxes, their existence and operation of their company, their authority as an individual to sign documents on behalf of the company, those sorts of things are really within the seller's control, and they don't present scenarios where there's unknown risk. The risk is known, it's quantifiable, and really, as a result, should be the seller's responsibility fully. And in those situations, we don't see a basket or a cap apply to those. So the seller, regardless of the amount of liability, is ultimately responsible for those aspects that are fully within their control. Paying you, Craig, for example, if you're the investment banker, if they don't pay you and the investment banker comes back and says, hey, I didn't get paid on this transaction, the seller really should be responsible for that, because that was a seller choice not to pay you.
That's why we write it into the funds flow. We don't ever want to have that conversation.
You don't get paid, but just hypothetically, which is funny, because that one's always a fundamental rep. And I'm like, the broker, I've never seen a scenario where the broker didn't get paid. So
the deal doesn't close if we don't get paid, if it's in the funds flow. Well, it's funny, and we probably collectively have 1,000 horror stories, but we had a brother and sister. Brother had 90%, sister had 10%. And, the brother insisted that he had all authority, right? And I guess I'm backdooring into disclose, tell your lawyer, tell your investment banker, and we are going to ask those hard questions. Show me your operating agreement that you have the right to sell this business without your sister's consent, right? We're going to verify some of that. So some of those things, deals don't like surprises, and disclose, and we'll get through a transaction together. But if we get a surprise at the last minute, it's usually not good.
Yeah, and I'll add one more thing. You talked about hiring good deal counsel. I think in addition to kind of knowing what the sweet spot is on where the risk allocation should be, what's appropriate for the buyer to be responsible for, what's appropriate for the seller, the prompts related to those representations and warranties are much better coming from an attorney that does this every day, that has seen all sorts of issues come up in transactions. The ones that don't, they tend to miss things in disclosure, or don't think about asking. They don't ask the client the right question. And my Rolodex of questions to ask sellers in diligence and through scheduling the information for the reps and warranties has evolved over time based on experience and transactions. And so the more experienced attorney you hire to help you with your deal, the more likely something is not going to get missed.
Yeah, absolutely. We've seen it on both sides of a transaction, whether it be buy side or sell side. And the interesting thing, and I know when it comes to bringing that team together, a lot of sellers, they necessarily don't want to pay an hourly rate. They don't want to pay their CPA to be sitting next to their attorney and et cetera. But at the end of the day, a more efficient, more higher likelihood of close, if you get everyone working together, asking the right questions, you'll save yourself a lot of time and heartache, right? By making all that happen, which, penny wise, pound foolish, but ultimately, if you want to get a deal done, you gotta build the right team, and you got to make sure that they're working in concert.
Yeah, I mean the most successful transactions I've worked on are the ones where everybody is fully engaged from the jump. Everybody knows their role. Everybody is bought in on the same objective and is committed to helping the client meet that objective. And that means that at certain points people come and go. Like their role may be less and more at certain times of the transaction, but they're certainly knowing that it's occurring. They're ready to jump in when they're asked upon, and they work if they know what's going on, and they're fully apprised of the timing and the process. And when they're called upon to do their role of the transaction, they do it quickly and efficiently and cost effectively. And those transactions are the ones that work the best.
Yeah, yeah, indeed. A couple last questions.
Sure.
The first of which, I know, your firm has a broad range of expertise relative to practice areas. Are there instances where you'll bring another attorney in from your team that obviously may or may not have M&A experience, but maybe they're a tax expert, or they're, an expert in a different area? How does that serve the client in some of these issues?
Yeah, I mean, I'm proud to say that we, for the most part, can tackle any um, unique aspect of a transaction that a client may be faced with in a deal. So, give some examples. We have real estate counsel within our office. Oftentimes, a transaction involves some real estate component, whether that's a lease related to real estate, or working with a third party landlord, or perhaps the transaction involves the acquisition of the real property. We work symbiotically together to make sure that those transactions happen at the same time, that the terms are market terms, just like the M&A deal documents that I'm working on. And we collaborate on pretty much every transaction that involves real estate. I'll bring in one of my real estate partners to handle those aspects of the transaction. We also have a really strong ERISA practice, and that tends to be one that clients gloss over in a transaction or are not really aware of the complexity of it, and will just rely on their benefits provider to make sure that the representations and warranties are accurate in the agreement related to their benefits. We we do we have excellent attorneys that work on benefits work for clients and can make sure that everything beyond just making sure the representations and warranties are done correctly, that everything in administering those plans and potentially terminating those plans at closing is done properly without any risk to the seller. So we we do that work as well. We have state and local tax attorneys. We mentioned my estate planning team. We have litigators. Often they're not involved in our M&A transactions, but sometimes they get involved after an M&A transaction gets done, representing potentially, if we're a buyer, representing them with respect to issues related to the business against third parties, or if there's issues that come up post closing that we weren't aware of in the deal against the seller. So we do full service on those aspects.
Yeah, terrific. And maybe we can close with maybe your read on the market based on what you're seeing. It's 2024, it's a new year, and we've got some interesting economic considerations going on. And it seems that with the rise in interest rates and other things, we know that M&A slowed the last couple of years, but in my world, it's really starting to get busy. So maybe, sellers always ask, is now the right time? How do you kind of answer that question, or what kind of market conditions are you seeing that might be helpful to folks in our audience?
Yeah, I think we are seeing a lot more deal flow in Q1 this year than we saw even at any point of last year. I think there's a lot of momentum that was built up at the end of last year to get transactions done. I think there has been a bit of resetting in the market on pricing as a result of the cost of liquidity or the cost of capital from financial institutions. Certainly think that buyers that are doing balance sheet acquisitions that are using funds that they already have or have obtained through investment or securities offerings um, are finding good deals right now and are pretty active in the marketplace. I represent financial institutions. What I can tell you in that front is there's not a lot of commercial real estate lending that's going on, but there's a fair amount of M&A financing that's going on. So with the right deal, those transactions are certainly more bankable than an office building in downtown Tacoma or downtown Seattle. So um, those financial institutions need to make loans. That's part of their business model, and so they're prioritizing or strategically looking at other types of transactions to make loans on because commercial real estate is in a bit of a struggle right now. And so I think there's opportunity for buyers and sellers in this marketplace to find good transactions and get things done right now. Um, I will tell you that from the lenders that I have talked to, one of the key things that they look for is deposits. So if you want to go borrow to buy a business, expect that they're going to expect you to move some or all of your deposits to that financial institution as part of making a loan to you. But if you're willing to do that, if you're not tied to a financial institution and you have flexibility to move your deposits, now is a great time to go borrow money. So that may be advantageous for buyer strategic or private equity to go do leverage transactions.
Yep, that is certainly a good word. We're seeing the same thing in the marketplace. Well, Evan, thanks so much for joining me today on Middle Market Moment. How do folks get in touch with you?
Sure. They can go to our website, www.eisenhowerlaw.com. They can email me at emarques, EMARQUES at eisenhowerlaw.com. They can call our office, 253-572-4500. Any of those ways are great ways to reach me. And even if it's not something that I can help with, we certainly have attorneys within our office that can help with any legal issue that they may have and be happy to connect them with the right person to help them with whatever needs they may have.
Awesome. Thank you, Evan. Appreciate it. It's been fun. And thanks for everyone listening, and good luck on your journey to the deal of a lifetime.